Hey traders, this is Blake Morrow with Trader Summit, and I have with us today Mr. Rohit Srivastava from India Charts, and I'm going to bring him in right now and talk a little bit about the markets. Good to see you, Rohit. How are you?
I'm doing good. Really nice to see you back to the warm weather. It's a good evening here. Probably
Yeah.
the morning out there.
Well, it is morning here, evening there, and from what I understand, you were just in the United States. I hope you had a great trip while you were here.
Oh yeah, it was wonderful because it was really chilling and nice in April compared to the heat that we face out here. So we really enjoyed the weather and mostly on the West Coast.
Awesome. Well, we're glad to have you. You should come back anytime. But I wanted to talk about, it's been a while since we spoke, and actually it was the end of 2022, and you thought at that point in time that markets were, they were peaking. You were looking for them to be bearish in 2023, Nifty as well. Now it's been a lot of time that's passed, but how did you handle the breakouts in the markets, and did you shift? And then we're going to talk about how you feel right now. But how did you approach the end of 2022 and the beginning of 2023?
In terms of the scientific process, I layer two, three things which help us make those switches from time to time, which makes me more of an active manager rather than a passive one. So that means that on one level, I'm looking at wave analysis, which is the Elliott wave theory, allows us to do some level of forecasting of what we expect. Then we overlay on top of that sentiment, because sentiment must align with what your waves are showing you. And if they don't, then you need to look at alternate wave structures as and when possible. So sentiment becomes the second overlay. We can look at sentiment indicators. And then the third one is actually looking at the momentum setup. So if these three align in a particular direction, or if two of them are not in line with the third, we sort of make those choices as to when we should shift back and forth. So that's something I've had to do through this time period, because in December, you're right, December 22, it did look like things would turn out bad, and sentiment in India was excessively bullish, because we had just rebounded from the lows of June of 22, and I thought maybe another leg down would start along with the US after a brief rally. But by Jan of 2023, a lot of the US sentiment showed that it is possibly bottoming for a slightly bigger bounce up. So I think initially I thought you'll just get a bear market rally, but I thought it'll be meaningful to play. And so Jan 23 onwards, I turned bullish, but the Indian market continued to fall till March. It only started to move up after March of 23. So sort of I had to wait for that to happen as far as India is concerned. But globally, I got it right that it bottomed in Jan of 23. But what I thought then is that because probably it's going to be a bear market rally, things could flip back to the downside by the end of 23. And so as we got closer to the end of 23, I did turn bearish again. And there are two macro factors that played on my mind in doing that. One has been rising bond yields, and the second one is the rising dollar. That's what played spoilsport in 2022 in terms of getting markets down. So I thought if that happens again, if you get that again, then that could be a macro risk. So bond yields did start to edge up, in the last quarter between, I think, December of 23 all the way till March of, or even now, I think bond yields are pretty much elevated back from, 3 point something to 4.7% on the 10-year GSEC. And even bond yields in India did edge up a bit, but not much. We just went to around 7.2%, which is not a lot in this time period. But that's a risk that kept me bearish during the first quarter of this year. Okay. But now I think that risk is probably elevating or going away. So I'm actually flipping again after waiting for a quarter that possibly you'll get a correction, or possibly this was a bear market rally. And the switch is that the dollar probably peaked out in September. So that was one of the views I had earlier, that it's probably peaked out. So I'm switching back to that. So you won't see new highs in the dollar, and bond yields also maybe peaking out and ready to. They may not immediately roll over, but yeah, they should slowly start cooling off at some point of time in the months ahead. And what happens with markets is they are starting to anticipate that and move ahead in advance. So we've got to stay with the idea that these things happen. and that will probably drive equities much higher. And the strength apparently is in non-US markets. So whether we look at not just Japan, but Europe, which is looking
Yeah.
very good. And of course, parts of Asia, which were suppressed. I mean, India's been on a blast. Let's keep that aside. But rest of Asia, which was down, whether it's Malaysia, Taiwan, and so on, they're all picking up. So
Well,
I
you
think,
know, you're the founder of India Charts. Are you willing to show your charts so we can see what you're looking
yes,
at? Because I believe that that you being right now focused on other markets other than the U.S. I think you're spot on. We've got the German DAX, we got FTSE, we got you know, the Nifty's obviously continuing higher. So I'd love to
yes,
see what your views are here.
yes. So I'll start with Europe since I mentioned that. So I'll just switch to uh, the European screen. The interesting charts here are actually places like France and UK. So when we actually look at this, we would have thought, you know, any chartist who looks at patterns would have thought this is some kind of a triangular wedging pattern going on, you know, and that's what I was trying to play on. But what we have now is a breakout. So the moment we got this breakout, the flip I'm doing is that, so let me go to a monthly chart. It'll also sort of give you a bigger idea. What ended up happening in places like this is that France peaked in the year 2000, okay? And it's actually been below that level all the way till 2020. That's 20 years in a trading range. And broadly, it looks like a triangle. That's what I've put over here. And triangles are typically fourth waves. So what this means is long term, from the lows of 2020 COVID, we probably started something new, you know, and the doubt so long was, yeah, can we really start something new because, you know, things are bad. But we actually look at valuations. These are markets which were in single digit price earnings ratio. So compared to the US, much, much cheaper markets. And probably that's led to a lot of value buying happening over there. Apart from, of course, weakening the euros, the other trend which has probably helped Europe as weakening the yen has helped Japan. So now, so when I take this big picture that we are actually breaking out of this multi-year, you know, consolidation and accept that it is a new trend, I end up marking these as a series of 1, 2, 1, 2, and now you're probably starting a third wave of longer term. And even the most recent correction you see here is taking good support on the channels and started to head higher. So I could even mark this as 1, 2, 3, 4, but somewhere I chose 1, 2, 1, 2 because when I look at the Euro Stocks index, this third wave is actually shorter than the first. That's one of the Elliott wave logics that the third wave cannot be the shortest. And so when that happens, the first choice is to consider it as the first wave of the third and consider that means it's going to extend much longer than what we usually expect. So that's sort of why I've marked it as, you know, a series of ones and twos. But yeah, holding this channel, we started the next move up, which means I would expect the CAC to go to 8,700 in the coming weeks. And that's the setup. And so now with that in light, now when we see each and every European market, we're actually seeing some kind of breakout action and price advances. Like UK has actually been leading in a way that it's ended up at new highs before any other market. You know, what looked like something completing here, Mark 5, got a nice consolidation. And instead of what would have been a corrective counter trend move, you actually got a new move. I haven't put any count markings here because it probably been a series of ones, twos, threes, probably, you know, still building into a larger impulse wave. So
Yeah.
nowhere close to having completed something.
So I want to ask you here, like you see a move like this
Yeah.
in the FTSE, and you're right, it looks very impulsive. It's very strong. At what
Yes.
point do you think it peaks out? I mean, do you use oscillators or relative strength to recognize that the move is not you know, keeping up with strength? The price might be exceeding strength. How do you do that, Rohit?
Yeah, oscillators are useful. I have my own, which is sort of an you know, alternate to using maybe rate of change or using MACD. We sort of have a smooth version of rate of change, and that helps us look at the cycles in each of these. Say, for example, and I do this a lot more on the US. So I'll just you know, give you an idea. See, I have the indicator here. This is called, I've given it my name, Rohit Momentum Indicator. It says essentially RMI. It's a smooth version of the rate of change, which is pretty fast. But when we're actually looking at the long term, so if I take say let me take the US index, that makes it a little easier. when we are doing these counts, I'm actually overlaying momentum with sentiment, which is what I said early on, right? So when we look at something like this, okay, I consider the movements of momentum up and below the zero line as, completed cycles. That's the basic idea. So if you're actually looking at this is one cycle, then there's another cycle. It's like a sine curve, which is continuously going on in momentum. Above the zero line, back to the zero line, above the zero line, back to the zero line. And as and when we complete these cycles, so even there's a 2 touch points on the zero line here, so there are actually multiple cycles. Each of them could essentially end up being waves, right? So that's sort of an overlay. But that doesn't mean I don't need to do the wave counts. What I tell people when I train them on Elliott waves in our training sessions, I tell them you need to actually do the counts.
Sure.
And see that, yeah, this counts as 5 waves up before I mark it as one. The momentum overlay just helps us in getting a secondary confirmation. The third one is the sentiment overlay. So let us just take, say, for example, I look at the S&P 500 put call ratio. Okay. So one of the reasons, like I said, for me to turn bullish in Jan of 23 was that when we actually look at the overlay here of momentum, you see the put call ratio at one of the highest levels in probably COVID, right? Which is down here.
Yeah.
And that's where sentiment was down here. So when sentiment is this bad, and then I'm looking at the technical setup. The technical setup was essentially a broadening pattern. Okay. So essentially when we say it's a broadening pattern, we mark it as either ABCD or you say WXYZ. In either case, whether you mark it as Z or you mark it as E, we sort of completed something over here. Okay, which fits with the sentiment reading. And so initially what you end up expecting is, okay, if you've completed this fall, you're going to get some kind of retracement, which can do 61.8%. That's how we start off. Okay. And then subsequent to that, we have to figure out, will it stop there or not? So initially this will look like ABC. Okay, this looks like a top. It should be crashing, but sentiment again turns extremely bearish. Okay. And when sentiment turns extremely bearish, then from this point on, we have to consider the bullish case again. And so that's sort of what has been happening, that we've been getting these extremes. So here we got down to the bottom end. This is where I thought, okay, can we top out and get a sell-off because bond yields are rising? That is what we were trying to weigh between Jan and April of this year. But during this period, we've seen a very short correction, I think, in equities.
Yeah.
And in the meantime, what I noticed in terms of sentiment, other things, there's of course one sentiment measure is the positioning, the COT report. You actually have got a significant reduction in shorts in the US bond market. Okay, so last year when bond yields were rising, the short positions were going up. Now, when bond yields are rising, the short positions are going down. So somewhere, as bond yields continue to rise in the US, okay, so let me just open the 10-year. We actually ended up getting a big reduction in the short positioning. And that has led me to think that, let me just make this a line chart. Maybe there's some setting. Yeah, so maybe I've hidden it. Yeah, I've hidden it. Okay, there you go. So yeah, this is the 10-year. So when bond yields were up here, there was a huge short position. But now when they are here on the 30-year, the short position is almost zero. On the 10-year, more than 50% of it is covered. So somewhere the big players who've been shorting this market, the bonds basically are cutting back. So surely they are betting on that, well, bond yields are not going to keep rising, a long way. So that is one reason for me to think, okay, then maybe things will change. The recent Fed meet sort of was the icing on the cake in terms of taking that view, because the Fed is backed off on quantitative tightening. They don't want to raise rates. Okay. And they want to move.
Can I ask you a question here? How about excuse me.
Yeah.
How about if yields start to fall because economic data starts to get worse?
Yeah.
Would that change your view of equities?
That is a very interesting question. Because that emanates from the whole world watching the yield curve, and every time the yield curve steepens, then bond yields come down, and it's a recession, right? So, and we've tried to think over that over and over again. fact has that reading has been true all the way back to the 70s, but I do think that in the 70s there were lots of yield curve inversions and steepenings that did not result in major recessions or did not result in major market crashes. So it's actually not necessary that it works out exactly that way, or maybe you can remain inverted for a longer period of time.
Yeah, we're proving
Somehow,
it now.
yeah, somehow liquidity. So somehow now in this period, in our more recent period, liquidity seems to have played a much bigger role than anything else than it did in the previous. So if we're actually comparing, say, 2000 to 2008, when you didn't have a QE period and liquidity injections, to now, that sort of doesn't seem to work in the same way, because now they're injecting liquidity, whether they're using the TG account sometimes they're using something else. Now the treasury is saying we're going to buy $2 billion worth of bonds every week. So the liquidity is going to be there. So which means so more important than whether bond yields are going down or not, what I would say is look at what bond yields are doing to the dollar. So if falling bond yields are accompanied by a rising dollar, then that would be a situation where it's a recession and there's a risk of trade happening. But if you have falling yields and you have a falling dollar, okay, then you're going to be in an environment where liquidity is expanding, and that liquidity then starts flowing to some assets. And more often than not, when the dollar is weak, a lot of it flows to either your Asia, which is what we saw from 2000 to 2008. Asian markets, emerging markets start doing well, or it moves towards Europe. So we see. So I think other markets attract that liquidity. You have Japan also now rebounding. So which market will attract that excess liquidity is becomes a more important question to me than is it really slowing things down because rates are going. I mean, are rates going down because of a slowdown?
Yeah.
No, is it just rates going down because inflation has come off, but you don't really have a slowdown?
So where do you with that being said, that means you must have a pretty solid view on the dollar. Are you, because I think the dollar's had a great run. We've seen it come off of its recent highs. Where do you think the dollar is going from here? I think the consensus would be pretty split. You got some people that think the dollar is going to rally to new highs, but you have a lot of big names that feel that the dollar is ready to turn lower. Where do you stand?
Yeah, so I do think that the dollar had a very long run. So if I actually zoom out and see a slightly longer term chart, let me see if we can get a 20-year run. Yeah. So when we look at this really long chart, it has, of course, my count jumbling all this up. But let me just put a parallel channel so we can give the wave perspective on this. So this is what has happened. My sense is, from an Elliott wave perspective, we've done what we just discussed, W, X, Y, X, Z. So what wave analysis tells you, either you do A, B, C, D, 1, 2, 3, 4, 5, W, X, Y, Z, all of them end in 5 waves, essentially. And it ends with something like this, where you're at the top end of the channel, bottom end, top end, bottom end, and you actually reach the top end. So there was a very good reason why the dollar could have topped over here. I did spend some time trying to think whether this could be different. And I did that by looking at the momentum overlay. So again, if I go back to the US dollar here and I look at my momentum overlay, okay, so I'll have to do that on maybe this chart. Yeah. Yeah. And then I see it on a slightly higher time frame. I go to a monthly chart. So I was actually watching, oh, well, it's holding the 40 month average here. My momentum indicator, let me just clean out these lines. Yeah. My momentum indicator here is coming back to a buy. Can that be bullish for the dollar? Okay. So that's the momentum setup sort of telling you that, okay, can something happen? And on the other hand, I look at this and I say, but we've already done this. Has the dollar really peaked? And we've done something similar even on the British pound. Long term, it looks like one big, complex triangular pattern, which is sort of complete.
Yeah.
So
based on your analysis, I'm going to assume you are probably in the fairly neutral camp, because I think unless you correct me if I'm wrong, you could see it going either direction from here.
So I'm not neutral. I'm just open to the idea, but I am open more to the dollar entering a bear market than a bull market. And I'll tell you why. I started taking that view back here a bit early. But The good news is that by taking that view early, I was able to call a bottom in gold back here. And I was able to call a bottom in the commodity cycle back here. So that's sort of an intermarket, long-term intermarket divergence that even though the dollar's peak had not been reached, okay, we got the bottom in the commodity cycle when the dollar was falling back here in these two. This is the inflation spike that is the inflation which has caused the dollar index to run up, the rates to go up and all that. But we've had a very long bull market in the dollar. All the previous bull markets in the dollar ended in 9 years. If we just go back and see history since 1970, this one's now gone on for much more than that. It's like probably 11 years or 12 years, or maybe even more if we take it from all the way from 2007. So it's sort of at the fag end. I think at some point of time, the commodity cycle, okay, and the new highs in gold are telling us that this is done. And we are going to get that dollar bear market because we have reached the top end of this channel. We've completed everything. So the wave perspective says it's about time we get the dollar bear market. So
All
every
right, well,
time,
go ahead. I'm sorry, I didn't mean
so
to interrupt.
every time I'll get a setup which tells me the dollar can go down. Okay, even in the medium term. So even if my weekly momentum setups go bearish, I will take a view that the bearish phase can actually come back.
All right. Well, let me ask you this. If you're more of a dollar bear, you're leaning that direction, that must mean you are a gold bull. So I'd just like to see, before we wrap things up, I'd love to see your gold view.
Yeah. So I'm just putting my current count on what I'm thinking of the dollar. Now, this is a very rare pattern.
Okay.
I'm saying that the fall from here is way. Possibly this entire complex phase, we've seen lots of ups and downs in the dollar, is a wave B. It's like a diamond. It's not like the perfect contracting triangle. A diamond is a more classical pattern. Again, it has 5 waves. And most probably what we end up getting in the dollar, if we don't go above this recent high that we made here, in close to 107, we should be heading back to somewhere in the low 90s. That is sort of the thesis I'm working with right now. And with that, yes, you're right. If I think of gold, yes, I am a gold bull.
Yeah.
Long term, I think gold is in a long bull market, and that sort of should take most of the commodities which we are starting to see that, maybe copper and others, but I'll just open gold. Yeah. So I think gold actually bottomed in 2015, like I mentioned, with that dollar top back then. In fact, we had a very good ending pattern here. So the way I've actually marked this whole thing is possibly we've completed a series of, I think this is either this is going to be 1 and 2. Okay, we can do 1, 2, 3, 4. So then we've started a fifth wave to new highs. I do have an alternate count where I may even think this is 1 and 2, but I think this right now this would make sense.
Well, if it was the third wave, if it was the alternate count, we'd have a lot further to go in gold.
A lot further to go, and there's reason to think that is because even longer term, if this is just the first wave of a new bull market,
yeah,
okay, and we started something new here, it's possibly got long way to go.
Got it. Well, so I think a lot of gold bugs are gonna love hearing what you have to say. I'll tell you, Rohit, I look at gold very constructively. I mean, I think we all have to respect the fact that it has broken out, and the ramifications in the FX market should be a stronger dollar, or excuse me, weaker dollar. And based on your analysis and what you've showed us here today, it seems like equity markets, especially European markets, are going to continue to go higher, and that might include the Nifty, right?
Yes. So I think equities, Europe, Nifty, and the Asian and emerging markets actually making a comeback. And since you discussed gold, I think we should also just drop a light on. That's why I have silver on the screen.
Yeah,
Silver's been the dull guy. He's really not joined gold on the way up. But it looks like this time around it should happen. We should get that breakout from this zone. The signs are there. The momentum setup is there. We've in fact, the way I've drawn this line, we've already started to break out above it. So silver should be going back to the highs of $48 that we saw in 2011.
Woo, that would be something. That would be something. I think
Yeah.
people have been waiting like
Waiting
literally
for it forever.
10 years plus for that to happen. So that's great. Rohit, I love your work. Always have. I'm a big fan. Tell us a little bit about how we can follow your work as traders. I know indiacharts.com, but where else can we follow your work?
Yes, at India Charts on most social platforms, Twitter, ideally, LinkedIn, Facebook, everywhere we are there as at India Charts. That's my handle everywhere. IndiaCharts.com is where I publish my write-ups on a regular basis. So that's where people can read my work on a day-to-day. We have an India Charts app, so they can even read it on the app. They don't have to necessarily get onto the desktop.
Awesome. Well, thank you so much for spending your time here on Trader Summit. It will be definitely not be a year till I reach out to you the next time. It was way too long of a pause. I'm going to have you on in a couple months and see where you're at this summer. Sound good?
Sounds very good. Thank you so much.
All right. Thanks, Rohit. Great to see you and great to talk to you. And thank you for spending your time here. And if you guys like what you heard from Rohit, make sure you give him a thumbs up, subscribe to the channel so you don't miss any of this exclusive content, and jump down in the comments below if you have maybe some differing views from Rohit. All right, Rohit, thank you so much. And thanks everybody for listening in. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.